Hello everyone, today we are going to discuss an interesting topic which is about the mutual funds. So here I will be decoding many of the myths which are associated with the mutual fund. So many of the people or the investors or the retail investors are new to mutual funds these days, but you can see a lot of DII, domestic institutional investors, putting money into the stock market and stabilizing the market. So all this money which is put by the mutual funds is actually coming from the investors like us, retail investors, who is investing through mutual funds. So mutual funds, as you know, it's a pool of fund which can be equity, bonds, gold, cash market, etc. So these are the investments which we are getting from the investors like us, and the fund managers will manage the fund for you and switch the funds or invest in new companies, shut off non-performing companies, etc. So we will not get much into what a mutual fund is, but end of the day, it's a pool of investments. Equity investments are like majority the investments is in stocks, and if it is hybrid, then it will be a mixture of bonds and equity, etc. Based on the underlying investment, the returns also varies. Equity obviously will have high risk and high reward, and bonds will have lower risk and lower returns as well. So SIP is something which you should be doing every month. So almost, if you ask me, almost 30% of your salary or income should go to mutual funds, and out of which there will be SIPs done in various mutual funds. So these days I'm seeing investors always switching the mutual fund type because they are looking at the ranking in various apps available, and in that, based on the ranking, because the ranking keeps on changing, because there are underlying assets which are performing or underperforming based on the market scenario, because stock market is obviously subject to market fluctuations. So based on that, they are evaluating the short term ranking and they are switching the funds, and their investments or returns are reaching nowhere, and they are getting a subdued returns. So my suggestion is that find out good mutual funds. End of the day, you have to look at the underlying assets, good portfolio of stocks or bonds, and then invest in such a company. Yes, look at the rank, but don't go for the top rankers, or neither go for the bottom rankers. Go for mid rankers, like in the 10 to 15 rank range. So in that, if you see, I've always seen that they have been consistently performing, though not overperforming or underperforming. So easily you will get a 15 to 18% returns in such mutual funds, and in worst scenario, they may go as low as 8% or something once the markets are down. But year on year, if you see a CAGR basis, you will get returns much higher than 15%, which is fairly good as far as mutual funds are concerned. So you should not keep switching the funds. Stay invested in one fund. If there is no underlying change, if there is no fund managers being changed because of some notorious actions or any ill doings, it is always better to stay invested in a single or the existing SIPs or the type of mutual fund, and stay invested for a very long time, so that you get the compounded returns. Because if you redeem the mutual funds, whatever you have invested in, then you will be liable for taxation on the same. It will not be tax effective. Also, don't look for short term returns, just look for long term returns and long term performance of the portfolio of the mutual fund. Mutual fund performance is definitely based on the stock performance, and it is market linked. So market dips down means the mutual funds also goes down. Utilize that opportunity for buying the dips, so that you can average the investments and you will get more units for the lower NAV. And then once the market goes up, then you will get the appreciation. Expense ratio is something you should really look at, and if the expense ratios are higher, which is the management fees which is taken by the fund managers or the team, so if the expense ratios are high and if the returns are subdued, then better to switch the fund for sure. Past returns is not always the futuristic projection of the mutual fund. So that is why going for a mid rankers will help you compound your money on a longer term. For an example, the past performance, like some mutual funds is invested in stocks like Adani. So last 3 years, the Adani stocks has doubled, tripled, or it has gone to a multi-bagger level. So your mutual fund in which it is invested in also would have gone very high. So you will think that that mutual fund is the best mutual fund. But now currently Adani is facing issues. Then such risky bets would have almost half the investors' money. So you cannot judge the performance of the mutual fund based on the past performance. You should really look at the underlying assets and how they will perform or how good they are, and based on which you can also compare some ranks and ratings in various apps, and then decide on which mutual fund to stay invested in. Mutual funds will also have beta rating. So beta in the sense, if beta is 1, then it will move according to the market. If beta is less than 1, then if the market volatility is high, also the volatility in the particular mutual fund will be lower. And if the beta is more than 1, say 1.5 times, means if the market moves 1 time, then this moves 1.5 times. So the fluctuations are much high. So it is better to go with lower beta if the risk returns are good. Over diversification is something which you should avoid. You should not go with some 15-20 mutual funds. It is better to stick with, say, maximum 8 mutual funds, wherein you will have one multi-cap, one mid-cap, one small-cap, one large-cap, one international fund, one ETF, etc. So this is like proper diversification in the asset classes, and one hybrid fund wherein it's a mixture of equity and bonds. So that, or if you want a bond fund also, you can invest in that. So you will have a mixture of all the asset classes in the mutual fund, and you will stay diversified within the space. But if you have same portfolios overlapping in various mutual funds, then your fund performance can be subdued. So over diversification or huge number of mutual funds is not recommended. If you see majority of mutual funds, if it is large cap, then majority of large caps, good performing large caps will have almost the same stocks underlying in that. So better to choose a good one and then stay invested. Also, the mutual funds which you are selecting should be goal based. Say your child's education, your child's marriage, then your retirement, then buying a home, then buying a asset class, commercial real estate, etc. So you need to put or decide a particular lump sum cost which you will require at that time, and then stay or start your SIP for a particular amount and calculate the returns based on some average conservative 12% return, so that you will get or achieve the particular amount for investing or for executing the particular target or goal once the time matures. Track record of fund managers is something you should really look into, though the past is not again the projection of the future, but fairly you will get a good idea about the fund performance once you evaluate the fund manager's performance. You can look into various videos, their interviews, then documents available on the particular fund manager, and this will help you analyze the same. 5 years rolling return is something which you should see, which is the 5 years performance of the particular mutual fund. So various apps you can use, PT Money you can use, Value Research you can use, Money Control you can use. So those apps will give you the return ratio, and you can see the fund performance and accordingly invest. Also, you should see the returns of that particular mutual fund in a bear market, and also the riskometer. So these are all riskometer in the sense high risk, low risk, medium risk, etc. So this also has to be evaluated while entering the mutual fund. So if you are at a lower age, you can go for high risk, high equity exposure. If you are going in a mid age, then you can go for average or medium risk. Then if you are in the retirement time or aged one, you can go for low risk, high bond exposure, lower equity exposure, etc. So that mix you have to really analyze while going with the mutual funds. Everybody cannot go for a particular mutual fund. Every age and every target or every aim or every goal is having a particular type of mutual fund to be invested in. CRISIL rating is also something important, so that the rating of the agency really shows how trustworthy or how reliable or how stable the mutual fund is. Exit load is something you should look at. So if you are investing or if you are getting into a mutual fund and if you want to exit it, then some mutual funds will have some exit load within 1 year or within 6 months. So what is the exit load, and is it too high for you to bear? This also you need to evaluate. All the SIPs can be done these days online. Earlier it used to be offline. We had to send letters. Say 10 years back, you had to send letters to the particular AMC office, and if you want to cancel, you have to send a letter, you have to go to the office otherwise. So these days it is completely online, cancellation and registration, which has all gone online. So it is very simple. Another thing is that you should, if you ask me, go with a direct mutual fund. So there are two types of mutual funds, direct and regular. So regular is through a distributor, and if it is direct and it is directly you are investing. So if you are going through, so if you are buying a mutual fund through a third party, like if you are having an ICICI direct account, then you can invest in mutual funds in the ICICI direct platform. So you can only invest in regular funds. So say there is a mutual fund like SBI small cap fund, so it will have SBI small cap fund regular fund, SBI small cap direct fund. So SBI regular fund will have an NAV, and the direct fund also will have another NAV. Though both are holding the same asset portfolio, the NAV will be different in both. So in the sense, if you are investing 5,000 rupees for an SIP for the same fund, you will get lesser number of units in case of regular plan, and in case of a direct plan you will get higher number of units. So this will be normally in small paisas or maybe rupee, small 1-2 rupee difference, but still on a longer run you are paying this amount monthly and you are having multiple mutual funds and you are doing this for a longer term, say 20 years, then you will have appreciation also over these rupees, and on a longer run if you see that chunk of money, it will be in huge amounts. So why to give away that amount to these mutual fund agencies? So let us directly go to the uh, particular AMC, say if it is SBI mutual fund, if it is Axis mutual fund, if it is Parak Parik mutual fund, you just directly go to their website, register there, and uh, register for the SIP. Even in platforms like Zerodha, they are offering direct funds, so you can also opt such direct funds through uh, reasonable platforms like Zerodha. Otherwise, you can directly go and invest in the AMC's site as well, and they will have their own app, and also consolidated portfolios will be sent through CAMS and Carvi to your email ID on your request. Now, the last point which I want to discuss is regarding the best date for SIP. So, best date for SIP, if you see on a uh, great research which is done by various agencies, it is understood that around 25th, around last 25th to 30th will be the best date, because at that time everyone gets salary in the first week of the month and investments goes at that time. So there is huge fund flow into the fund and the NAVs will be higher at that time. But towards the end, there is nobody having investments because everybody would have spent their money. So investments coming into the mutual funds are less. So normally it is seen that slightly there is a dip in the NAV. So if you invest towards the last of the month, you will get a slightly lesser NAV, which means a higher units. So this is if you see theoretical way of investing. So if you see you are getting the salary in the first week of the month. So if you are not investing at that time and waiting for the 25th or 30th of the month, then maybe you would have spent that money and you will not have the money to invest in your mutual fund. If you have that real discipline of keeping the money and you can invest it at that time, then it is fair enough. Otherwise, simply if you don't care for 0.15 to 0.2% returns, then it is better to give away that and invest in the first week itself, or first day or second day where you get the salary, so that you are well disciplined in your investments and don't miss out the opportunity. So hope this session was useful for you. If you like the video, do hit the like button. See you in the next video. Till then, happy investing.